off. Americans return to space as Discovery clears the tower.
Welcome back, TTMTrades. Today we're gonna talk about the S&P 500, or its ETF SPY SPY. Okay, and what I think is going to happen and what play that we made to make some money on this. Okay, so long story short, if you haven't noticed, the implied volatility on a lot of these options are pretty high, right? Depending the time frame and everything that you're looking at, right? If you're trying to swing trade day to day, or week to week, the implied volatility on a lot of these option premiums are high. I'm looking at implied volatility of anywhere from 20 to 30%. And as you know, volatility plays a big deal in how your options are priced, right? So for an example, if I just pull up the chart here, not paying any attention when we was playing Apple. I think I took Apple puts right here about a week ago, and when the price action gapped down the following day like this, I think I only made like a 50% return on that gap down, because when I bought into those Apple puts, the implied volatility was already pushing like 25%. So when it gapped down that morning, the premiums were already overpriced due to the volatility in the market, and I didn't make that big of a return, right? So seeing that, I knew I had to change my overall baseline strategy so that way I can get more bang for my buck on my options. Okay. And we've been tracking the SPY, breaking down all the way from when it first started back in, late February 19th through the 21st, right? So just looking, right, if we just do an overall quick view of the SPY, right, I started looking, and we can see intraday on the 30-minute chart every once in a while, right? This is the Bollinger Band width right here. You get where the consolidation pattern on the price action intraday gets to a very low point. As you can see here, the 1 standard deviation and the 2 standard deviation, the green and teal Bollinger Bands, where they begin to constrict. And sometimes that helps. That's a good time when I see that my Bollinger Band width is below average. That's a good time to try to snipe some intraday trades, because your premiums come down just a little bit due to the price action consolidating over this 2 to 3 day range, and that's a good time to snipe your position right before the volatility picks back up, because once the volatility picks back up, then your premiums on your options begin to skyrocket, because you have to price in that volatility. So every once in a while you'll get a good trade intraday, but the biggest thing was the market is very volatile overall, right? So on an intraday basis, it's very volatile. As we look at the 30-minute chart, 2-hour chart, you can see here the Bollinger Band width, which is continuously above its average. It consolidated right here for a minute back on March 8th to the 9th. As you can see, the bands beginning to constrict, and that being below its average, reflecting that. And then the volatility began picking right back up the following week. So this would have been a good time to snipe an entry for some puts for low premiums. But again, even looking at the 2-hour chart, you can see the volatility is very high, constantly pushing outside that 1 and 2 standard deviation Bollinger Band, which is how you price your which is a part of pricing your premiums on your options, right? And looking at the daily, you can see the daily is pushing outside this 2 standard deviation Bollinger Band every single day. So prices are high on an intraday basis, day-to-day basis. You look at the weekly chart, it's pushing outside of its bands here, and you can see the volatility is very high above its averages. So premium options are very high on a week-to-week basis. So I started looking at the monthly chart, and you can see here on the monthly chart, the bands. When I started looking at this was sometime last week before we had this drop below the band right here. The price action was still between its 1 standard deviation Bollinger Bands, which are the green lines right here, right? And with the price action still being between its bands on a month-to-month basis, the overall long-term implied volatility, if you look for options on a month-to-month basis far out, the premiums are very, very low, okay? Because you haven't had a big month-to-month move to break you outside of the bands, right? So one thing we was talking about in the Discord, as I try to pull this up right here, give me a second. All right, so one thing we was talking about in the Discord made a, back on the announcements back on last Thursday, we said the only chart left for price action still within its bands, as we can see below, monthly chart, as we can see below, 256 is our next line of support, and then afterwards 236, right? Remember, this is on a month-to-month basis. If we break out of the monthly bands, then 167 is below for the 150 SMA, which correlates to the last major area consolidation back in 2015, right? So if we go back to the charts and we look at this monthly chart, right? This was last Thursday before we broke down below that 256 range we was talking about, and that 237 right here where it's sitting at. So if we look at this setup here, right, on a week-to-week basis, day-to-day basis, as you zoom in, it's a little hectic, but when you zoom out, right, the overall uptrend was still somewhat intact at that time when we made that post last Thursday, right? So what we wanted to do was we wanted to snipe early entries on a far out 3-month time frame before the monthly chart began to break down and break outside of its Bollinger Bands, its 1 standard and 2 standard deviation, right? So we zoomed out to 3 months and we started looking for puts, knowing that if this broke outside of this 254 to 236 range, and as you can see here, if I mark the chart, because the Bollinger Bands automatically adjust to the price action, and it does all of the resistance and support and volatility for you within the bands itself, right? So I rarely have to draw lines, but I'm going to draw the lines just to show you. If you look here where that 1 standard deviation Bollinger Band at, that green line, that was this area of consolidation here, and then you put the other line where this 2 standard deviation Bollinger Band is at. That's the support line right where the 2018 dip happened. Before we had this strong rally in 2019, right? If we bring those lines down to the 150 SMA, if we drop down to here, then that's that consolidation period right here back in 2015, 2016, before you get this strong breakout to the upside. And I honestly think that's the area we're going to push down into. All right. Because once we come out of this band, out of the bands right here sitting at 233, there's no logical area of support from here all the way down to here. There's nothing but space and opportunity for a free fall, right? And I think that's what we're going to push down to. We're going to drop down to this 195 area where this old line of resistance is at. It should become support. That's a rule of thumb in trading. So we should dip down to this 195 area, and then if we break through that, then we're looking at 167 where the support was sitting at as the price action was consolidating last in this range. Okay. And that's where the 150 SMA is at. And I think that's where we're going on a month-to-month basis. And that would pretty much cut the SPY in half. That's a 50% drop right there on the SPY. Okay. Now, if we fail this 167 area, now we're looking at dropping all the way back down here to this 122 range where you can see this line of resistance was at as the price action was trying to break out. And that's an even steeper drop. Okay. Now, is that possible? It is definitely possible. Okay. It is definitely possible with the way things are going. The Fed's cutting interest rates to 0 and the market's still not reacting to it. Them once doing repo purchases, but stop now. And just pretty much throwing everything in the kitchen sink at the market to try to save it, and nobody's reacting well to it. Okay, so I honestly think that we're going to break through this 233 area, which correlates to that 2018 dip we had prior to coming into 2019. If we break that area, then again, it's a free fall down to 195 in the 167 where you get this area consolidation. Dip down, run up, resistance, dip down, resistance, dip down twice, resistance, and then you get the breakout. We're going to go down to that 195 to 167 area. Okay. So with that being said, we went ahead and positioned ourselves for this drop, and we bought 3-month puts all the way out to June. We went ahead and bought the open SPY 100 puts at 16 cents, expiration date June 2020, And then we also bought to open SPY 110 puts at 35 cent expiration June 2020. Now, why those in particular? Do I think the market is going to drop down to 100 and 110 by June? No, I don't. Okay, that's a pretty big drop within the 3 month time period. Is it possible? It could be if the market keeps selling off like this. But do I think it's going to happen? No, I don't. Okay. Reason why we bought so low down into that area is because the 100 and 110 puts, if you look at them, as I bring this up, you probably won't be able to see it. No, you can't see it. All right. So just looking at this, the 100 and 110 puts, if you want to pull up your SPY options, the 100 and 110 puts at that time, the implied volatility on the 100s were like 0.85%, and the implied volatility on the 110 puts June 2020 were like 0.63%. They were very, very low, right? And that was due to the price action on a month-to-month basis still being within the one standard deviation top and bottom Bollinger Bands, which showed that the volatility wasn't very high on a month-to-month basis, right? It's still within the bands. Volatility is still very low. With the way things are going, we know the price action is going to break out of the bands. I mean, just look at the setup. You know, you get this crossover on the PMO and it breaks above both its averages back in 2010, and it's been running consistently above its averages nonstop. Now, as you can see, the PMO is beginning to cross below its long-term average of the 75 SMA, right? You can see each month the volume on the sell-off is beginning to pick up. So we haven't even seen capitulation, which is a large sell-off in the market, to show that everybody who wanted to sell also at one time it got out. And what I mean by that is if you look at the 2018 financial crisis dip, as you can see the price action as it was dropping, you start getting these large spikes in volume showing extreme measures of selling, right? We haven't even got to that level of selling yet, right? So the market hasn't really sold off yet, all right? But that's what we're looking for on a month-to-month basis. But again, just to set up the overall, the PMO gives me the trend, but you can see the overall trend is beginning to slow down and fall below its averages. RSI got rejected by its long-term average. And again, I always tell you, anytime a stock or ETF or whatever with the RSI is in a strong uptrend, it will stay above that 40 to 50 area. So again, the strong uptrend that started back in 09 from the financial crisis, you can see the RSI stayed above 40 and 50 every time it pulled back, right? Pull back above 40 and 50, pull back above 50, pull back above 50, and now it got rejected by its long-term average, and it broke below 50 and 40, right? So just that rejection, PMO is slowing down to show that the trend is reversing, and the volatility is very low on a month-to-month basis, right? As you can see here, this period of consolidation right here from 2015 all the way to 2016 before it got this breakout, you can see that the volatility was very low at that time, right? And then you had to break out with this high amount of volatility. Now, again, you're looking at low volatility, right? Which, again, where there's low volatility, high volatility follows, which tells you a big breakout is about to happen soon. And this is normally a good time to position yourself as far as option pricing and premiums and the implied volatility that affects those prices. This is a good time to position yourself before you get a breakout to the upside like this outside of the one standard and two standard deviation Bollinger Bands. Because once you get that breakout on a month-to-month basis, those premiums are going to skyrocket due to the volatility and it having to price in the volatility into those premiums, right? So you want to start trying to position yourself now. Now, is there a possible short-term rally? Yes, there's a possible short-term rally, but I don't see that anytime soon because the daily hasn't even begun to set up for a temporary short-term rally. Even a 2-hour chart, right? I try to look for temporary signs of a short-term rally. And what I mean by that, if you look at the 2-hour chart, it is way below its long-term trend average and short-term trend average, and it hasn't even crossed over as far as the PMO itself, and the volatility is still very high, right? So what I'm looking at is something to where the volatility slows down and begins to consolidate, meaning the Bollinger Band width comes back below its average here, as you see here, and I'm looking for the PMO to kind of flatten out and curl back up to get above its averages. Once I see that, then I know we're going to have a uptrend on a day-to-day basis, a small rally, right? And with every trend, on an uptrend, you get the run up, it pulls back, run up, pulls back. Same thing with a downtrend. It's gonna drop. You're gonna get a rally to the upside, and then it's gonna drop and create a lower low. All right. So do I think that's gonna happen in the future? Yes, it's gonna happen in the future. I give it about another week of selling, which will probably be this week here. Another week of selling, and then probably next week we'll get a small rally on a day-to-day basis, probably to the upside, and then we'll come back down and create a lower low. Okay. And what I mean by that is something like this on the 30-minute chart, right? Where you get this dip down to 285, and then you get a nice little rally up to 313, and then the rally fades and it creates another lower low below this one right here. So that's something we'll see on the 2-hour chart going into a day-to-day basis. So I do think we'll get a small rally here in the near future, but that's a good time to use a small position size in your account to play that small rally, and then once that rally begins to fade, go heavy with puts and play it back down to the downside. But right now, we're looking at coming, if we break below that 233 area, we're looking to come back down here to 195, down to the 168 range. Okay. And so far on those puts that we bought at 16 cents and 35 cents, the ones we bought at 16 cents are currently worth $1, so we're up 524% on those. And then the ones we bought for 35 cents, the 110 puts, those are up. Well, those are the 35 cent 110 puts are now worth $1.45 due to the increase in the implied volatility, and then it's also moving in the direction of the put price that we put. All right. So right now we're up 314% on that one, and then the SPY 100 puts were up 524%. So we're gonna hold this long term. I had some people ask me why didn't I sell it, take the profit, and then jump back in. Well, you got to think about it. If I sell it now and then I go to jump back in, I'm gonna buy it at a way higher price with the implied volatility at a way higher rate due to it breaking outside of this monthly band here. So it's best just to hold it, right, and then let this run all the way down to where it's going to run to, and possibly sell the puts at a much higher price, right? Just looking at volatility now, right, and I'm looking at the option chain right now. I'm pulling that up right now. On average, looking at volatility now, we go to the end of March, and we'll just go April 1st, right? Looking at volatility now, the volatility on average is sitting at 19 to 20% implied volatility, right? And the typical price is sitting right around, let's go out a week. The typical price for sitting right at the money is sitting right around $10 to $14, right? So why, I have so much time on them. I got 3 months on them, so the theta isn't killing me. Time decay isn't hurting me. The implied volatility has already risen, and it's going to continue to rise as the ETF continue to push us downward. So why sell right now at $1 and $1.45 when I can sell at $10 minimum if it continues to push in my direction, right? And if we sell that at $10 minimum, then we stand to make, give or take, 30 to 32,000 on it, right? So this is just more or less a long-term, being patient play, and not just trying to make some short-term money on this, but hold it for the long run, because we know this is going to continue to go down. Like I said, the only way I cash out of this position is if they say they came out with a COVID-19 cure. If they said they came out with a cure, then I would go ahead and close this position out, because now that changes the market sentiment to possibly begin for people to start trying to bargain hunt and buy stocks at a lower price and start creating a bottom, right? But it's going to take time to find a cure, right? Trump just announced that this could continue until August, and it's only March. So we're talking April, May, June, July, August. We're talking about another 5 months of this, right? So the market in the meantime is going to sell off heavy over the next 5 months until they get this figured out. And then even on top of that, with this going on for 5 months, it's going to create a ripple effect, because now it's going to affect all the different companies, earnings reports, companies paying on their loans, et cetera, et cetera. So even after 5 months, the economy is still going to be damaged overall, right? So we're going to play this for the long-term play and ride this one out and then go from there. All right, but till next time, TTM trades. We're going down to 195, as you can see here, down to that 167 range, give or take. And whenever I cash out of these puts, I'll be sure to update you all on them and how much we gained on these. But the overall long-term trend it looks real bad right now, very bad. All right, we already broke that key support of the middle Bollinger Band that's held on 1, 2, 3, 4, 5 different occasions ever since the 2008 financial crisis. From 2009 all the way to now, that middle Bollinger Band has held on 5 different occasions, and now 2020 we just blew straight through that middle Bollinger Band, and now we're pushing out of the 1 standard and 2 standard deviation Bollinger Bands. And I'm telling you right now, once we break out of that 2 standard deviation Bollinger Bands, those option premiums are going to skyrocket, because that implied volatility is going to kick in, and those option premiums are going to rise because now they got to price in that risk and that volatility. So there's still a chance to get in. That's just my play. I'm not telling you all to do that, but that's what I'm playing for the long term over the next 3 months. And then we took a strong position in gold. We got in gold pretty cheap. I did $200 calls on gold because I believe once the safe havens stop selling off due to a lot of big hedge funds and investors having to do margin calls, you could tell they was cashing out of gold, silver, Bitcoin. They was cashing out of everything because they needed the liquidity. They needed the money to pay off these debts and these loans. So that's why you see a large sell-off in a lot of the safe havens, right? But with the interest rate cuts down to 0, one, that hurts the U.S. dollar. With that hurting the U.S. dollar and the economy falling at the same time, investors are going to flee to safe havens such as gold and silver. So we've already positioned ourselves in gold with $200 calls out to the month of June at a very cheap price. I think we got in at like 70 or 80 cents. I got to go back and check. With a very low implied volatility on a month-to-month basis. I think the implied volatility right now on those calls is like 0.82%. So once everyone starts fleeing to the gold asset, then that volatility is going to get crazy out of hand, and then those premiums are going to rise too. So you want to start positioning yourself now on a long-term basis before everyone else starts doing it. So that way, when everyone flees to what you've already positioned yourself in, it'll be worth way more money, and then you could just sell to the next person that's coming in behind you to try to jump into the play and then cash out. All right. But till next time, TTM Trades, Discord is down below. If you want to leave a comment, hit that thumbs up button. If you got any questions, hit me up in the Discord. But till next time, I'm out.
Houston, Tranquility Base here. The Eagle has landed.